Hello, my fellow investors, and welcome back to another earnings report analysis as well as a quick stock analysis as well for the company, guys, General Mills. Now, I've never done this company on the channel, and they actually just had earnings today. A lot of people are covering like Nike, FedEx, but personally, I want to cover General Mills. They had it before market open, and it's interesting how they moved based on those earnings. You guys are going to be fairly surprised on it. It's very peculiar. So with that said, guys, let's get started with this analysis. So let's start off with looking at analyst estimates when it came to these earnings. We got here latest quarter's earnings for General Mills and Seeking Alpha. EPS normalized actual came in at $1.10, which was a beat by 4 cents. EPS gap actual $1.01, a miss by 5 cents. Revenue actual $5.22 billion, which was a beat by $28.03 million. So guys, 2 out of 3 ain't bad, and even the EPS gap actual, which was a miss, it still wasn't a miss by much. It was only a miss by 5 cents. So let's actually now read their earnings report. Now, as I always say in every single one of these earnings report, guys, I'm not going to go through this whole entire thing. It would take forever. So I'm going to leave you guys this link in the description below if you guys would like to read it. You can clearly see it is very lengthy. I'm not going to cover it here, but I will leave it up to you guys if you want to read it for yourselves. Now, let's actually get started with this. And actually, the first thing that we're going to do is the CEO's comments. Quote, "We continued to execute well and delivered strong top and bottom line growth in the second quarter," said General Mills Chairman and Chief Executive Officer Jeff Harmening. Okay, sure. That's the first time I ever saw his name. Quote, "Amid ongoing volatility in the operating environment, we remain focused on driving our accelerate strategy by investing in brand building and innovation, strengthening our capabilities, and continuing to reshape our portfolio. With strong first half results and positive momentum on our business, we are increasing our full year outlook for the organic net sales, adjusted operating profits, and adjusted diluted EPS growth. General Mills is executing its accelerate strategy to drive sustainable profitable growth and top tier shareholder returns over the long term. The strategy focuses on 4 pillars to create competitive advantages and win boldly, building brands, relentless innovating, unleashing scale, and standing for good. The company is prioritizing its core markets, global platforms, and local gem brands that have the best prospect for profitable growth and is committed to reshaping its portfolio with strategic acquisitions and divestitures to further enhance its growth profile." Now, the biggest thing that I definitely have to take from here, guys, is this second half of this first paragraph. With strong first half results and positive momentum, this is we are increasing our full year outlook. Guys, that is amazing. That's actually really good to see. Now, when it comes to their results, they actually summarize it pretty neatly over here. Net sales increased 4% to $5.2 billion. Gross margin was up 20 basis points to 32.7%. Operating profits of $800 million essentially matched year ago levels, reflecting higher gross profit dollars offset by higher selling, general, and administrative expenses. Operating profit margin of 15.3% was down 60 basis points. Net earnings attributable to General Mills increased by 1% to $606 million, and diluted EPS was up 4% to $1.01. So again, remember how we saw here in Seeking Alpha that EPS actually came in as a miss by 5 cents? Well, in reality, they actually went up when it came to their own earnings, right? When it came to their own EPS, going from last year to this year, they went up 4% to $1.01, which is actually really solid. And looking at each individual segment that they have, we can see that North America retail reported net sales of 11%. Their pet sector was essentially flat. North America food service was up 24%, and the international was down 27% for an overall net sales, guys, of 4%. And another thing that I would like to cover here, it is essentially their updated full year fiscal 2023 financial targets. We did cover this earlier in the article. However, they go a little bit further here. Organic net sales are now expected to increase 8 to 9% compared to the previous expectation of 6 to 7% growth. That is insane, guys. That's awesome. Adjusted operating profits is now expected to increase 3 to 5% and in constant currency compared to the previous range of flat and up to 3% in constant currency. Both the current and previous ranges include a 3-point net headwind from divestitures and acquisitions and an estimated 1-point headwind from the ice cream recall. Adjusted diluted EPS is now expected to increase 4 to 6% in constant currency. Free cash flow conversion is still expected to be at least 90% of adjusted after-tax earnings. The net impact of divestitures, acquisitions, and foreign currencies exchange is now expected to reduce full-year reported net sales growth by approximately 4.5%. And when it comes to their consolidated statements, we can see that at least when it came to their net sales, guys, take a look at this. 1 year ago, in November 28, 2021, they did $5 billion, and this year, same exact time frame, $5.22 billion. That was a change of 4%. Operating profits was essentially flat, though it did go down, but to be fair, they're essentially just putting it as flat, but it was slightly down. And when it came to their earnings per share, basic and diluted, you can clearly see that they both went up, going from 98 cents in 2021 to $1.01. And for the diluted, it went from 97 cents to $1.01 again, which is an increase of 3 and 4% respectively. So as you guys can clearly see, General Mills actually didn't do too bad. And in fact, they're projecting some pretty good numbers in the next upcoming year or so. Now, how did this share price actually move today? Well, let's start off with the ticker symbol for GIS, market cap of $49 billion, a PE of 17.48, and a share price of $83.13. Which, to my surprise, I kid you not, today, guys, they fell 4.6% when the market today was slightly up in the green. But yeah, guys, they essentially fell 4.6%, around $4 or so, which was again very, very surprising. Now, in the 1 year, they're still up a whopping 22.63%, year to date 23.6%, and the 52-week range, we are definitely on the higher end, going from $61.67 all the way up to $88.34. Now, they do pay out an annual dividends of $2.16 per share, which ends up being a yield of 2.5%, a payout ratio of 51%, 5-year CAGR of only 1.6, which is not really that good, 3 consecutive years of dividend payment. Ex-dividend date is coming up on January 9th, payout date is on the 1st of February, and they pay their dividends quarterly. And based off of the current shares outstanding, they pay out $1.3 billion in dividends every single year. In regards to the 5-year average free cash flow, they're still left with $1.3 billion, and as of their last year's free cash flow, they're still left with almost $1.5 billion. These payout ratios are 46.72% and almost 50% for the 5-year average. So now coming into the fundamentals, guys, a couple of things to note before we start. They are actually in 2023 already because they start their fiscal year in May, meaning that 3 years ago was when 2020 occurred. So just keep that in mind while we're going on with this. Now, starting with the net income, guys, we got $2.13 billion to $2.71 billion, increase of 27%. Only had 1 year where they went down from 5 to 4 years ago, but ever since 4 years ago, they have been consistently increasing. I gave this a 90%. Looking now at the free cash flow, we got $2.22 billion to $2.75 billion. The anomaly here was 3 years ago where they went up slightly more than average, but then they came back down the following year. This is probably a COVID related number, but even with that, they're still fairly positive and fairly increasing too the following 2 years. In fact, this was an increase in the 5-year of 24%, with an average of $2.58 billion. I gave this an 85%. When it comes into the revenue, this one's looking absolutely gorgeous. 5 years ago of $15.74 billion to almost $19 billion. That is an increase of 20.66%. Every single year has been consistently increasing every single time. I gave this a 100%. In the total assets minus the total liabilities, this one's also doing the exact same thing. As of today, they're up $10.8 billion. When it comes to this difference, which again, it is a fairly consistent increase within the past 5 years. Average assets is around almost $31 billion. Average liabilities is $21.23 billion. Doing this difference, we get $9.76 billion. I'm giving this a 100% as well. Cash flow minus liabilities, fairly surprising because their lowest point was actually 5 years ago at negative $19.9 billion. And I kid you not, every single year since then, they have been getting closer and closer to zero. Not by a lot, but I do like that consistency. Therefore, therefore I'm actually giving this a 100%. Looking now at the shares outstanding, this was actually interesting because they are up in the 5-year by around 1/5%. However, you can clearly see that they went up from 5 to 4 to 3 years ago, and then starting from 3 years ago, essentially during COVID, then they actually started buying back shares, which is again very interesting. However, as of today, they're up to 594.3 million shares. 5 years ago, it was 593.1 million shares. Again, increase of 1/5% on the 5-year, and from the previous year to the current year, that is actually a decrease of more than 0.75%. I'm giving this guys an 85%. And when it comes to the cash and equivalents, they currently hold almost $600 million with an average of $866 million. Looking at the overall grades, guys, we gave them the income at 90%, free cash flow 85%, revenue 100%, assets minus liabilities 100%, cash flow minus liabilities 100%. So that's 3 100% in a row. That's insane. That's rare. I've never done that before. And shares outstanding of 85% for an overall grade of 92%, meaning that this company is looking really solid when it comes to their fundamentals. However, guys, that doesn't necessarily mean that they are at a good price to buy at today. So let's do a discounted free cash flow, low, medium, high, using revenue growth, predicted share buyback, and the required rate of return. Revenue growth, guys, of 3, 4, and 5%, and a predicted share buyback of 1, 2, and 3%. With this, we get the target share prices, not adjusting for debt, of $66.94 to $73.23. Adjusting for debt, this comes down to $49.31 to $55.24, with a margin of safety of 5, 10, 15%. This is now between $42 to $52.50. However, let's actually change some of these numbers up a little bit, because remember, they are expected to increase their net sales to 8 to 9%. At least that's what they are projecting. So let's actually change these numbers to something along those lines. So let's say 7, 8, and 9% accordingly. And now we get the target share prices of $76.86 to $83.90. Adjusting for debt now, it is $59.23 to $65.92. With the margins of safety one more time, we get $50.35 all the way up to $62.62. In this scenario, we're essentially seeing that the target share prices, not adjusting for debt, are very close, if not there, like we see here with the highest assumption. However, guys, adjusting for debt, they do come down because they do have a lot more debt than they do cash on hand. Now, this doesn't mean that you go buy it. This means that you essentially have to do more research on it. Keep reading those earnings report. Again, the link will be in the description below. Have these calculators, guys. Every investment is the present value of all future cash flow, and this is not financial advice. So please make your own assumptions when it comes to this kind of company. Read the earnings report for yourselves and make your own assessments as to where you want to put your hard-earned 9 to 5 money, the one that you wake up every single morning at 5 a.m. or 4 a.m. or whatever, spend 8 hours dealing with customers probably, or dealing with managers that you don't like. You want to put your money, guys, in a place that you're not going to lose it, i.e. all of these hype stocks that are now completely crashing. That's why, again, I'm more than happy to give out these calculators for free. Link in the description below. When it comes to banks and insurances, you guys have the book value. When it comes to REITs, you guys also have my REIT evaluation calculator, and even a dividend tracking sheet for companies that pay out a dividend. Or if they don't pay out a dividend, you guys can still use it as well. It is kind of messed up right now, but it usually isn't like that. I mean, I have put it in several other videos where it does work. All I'm asking for in return, guys, for free daily content and free calculators is just help me grow my channel. Like, subscribe, comment. It really does help here with the algorithm on YouTube. I can't thank everybody enough. Let's make 1,700 the goal for subscriber count by the end of the year. We're so close. I believe we're, what, like 5 subscribers away, or like 6 subscribers away as I'm recording this. Guys, that would be awesome. It would absolutely make my year to just end it with such a banger. It was absolutely crazy. Now let's actually see this $2.16 when it comes to a dividend. Putting in $5,725, we get 68.87 shares, which is an annual dividend of $148.76, quarterly of $37.19, and monthly of $12.40. All in all, when it comes to General Mills, I gotta say their fundamentals look fairly decent. Actually, really deep, really good, actually. I don't know why I said fairly decent. It's above 90%. However, personally for me, they are like right at the brink of whether or not it is a good price to buy that right now. And they are at that 52-week high, or at least close to that, right? So again, make your own decision as you see fit. But for me, it is a pass for now. Maybe if they fall a significant amount, in the next upcoming months because something happens, then that might be a pretty good time to buy. That pretty much does it for this video, everybody. Like if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow me on my news sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video as well as earnings report.